Public markets have their benefits, but they also have disadvantages. And one of the advantages of private real estate is that better deals can be available through private transactions through the virtue of inefficient markets. Hi folks, this is Big Mike Zlotnik, and today's topic is how's investing in REITs differ from passive real estate investing. Or another way to put it, investing in REITs is a form of a passive investing. So the main conversation here is really comparing publicly traded REITs. REITs is real estate investment trusts. Short for it, or abbreviation is REITs. Differ from investing into private real estate investment funds. There's a big difference is because, by definition, publicly traded REITs, they're public. One of their main advantages, if it's not the only advantage, is the fact that they're public. And there's something to say about that. Public market typically act to respond to information fast. As information spreads, the good news or the bad news, stock price reflects that. It's both a beauty and a curse. When the good news comes out, stock price moves fast and investors can achieve liquidity or sell the stock rather quickly. From that perspective, it gives them ability to act on good news quickly or bad news. On the other side, publicly traded have scrutiny of various regulatory reviews. Again, a publicly traded security, the additional cost of required compliance. There's some overhead related to running publicly traded REIT. When you compare and contrast public REITs to private funds could have many advantages over REITs, and we'll discuss. There's a couple of other elements of difference. Let me cover that first. So typically REITs are larger investment vehicles, and they focus on larger investments. So you may have $1 billion REIT, $2 billion REIT. Some of them focus on specific strategies such as self-storage or industrial. When you go in the private space, typically they're smaller, and that gives them a ton of benefits and nimbleness. When REITs acquires assets, they have to acquire in volume. They have to acquire a certain size of assets. So private funds can also focus on income strategy or a growth strategy. Most of the larger REITs typically wind up mixing them all up to strategies. Why? Because they're very large. They don't get to pick and choose. There are income funds and there are growth funds, obviously, as a standalone. But typically, you have more options and choices. Private market is where the better opportunities exist. Because in real estate, the better deals in real estate are found through relationships, through specific knowledge and connections. So there could be motivated seller situations. There could be motivated distressed assets. There could be motivated banks that need to exit a distressed situation. These type of situations are not publicly traded assets. They require connections. They require relationships. They require skill that is not often available in public markets. Public markets have their benefits, but they also have disadvantages. And one of the advantages of private real estate is that better deals can be available through private transactions through the virtue of inefficient markets. Further benefits of private real estate funds is more optionality in benefits focused, such as heavy depreciation deals or more tax efficient deals. Furthermore, there are deals focused on higher yield. So when you go into public markets, you may be able to obtain, let's call it a yield of 5 to 6%. When you compare that and contrast, you could easily achieve double-digit yield in private markets that are focused on private credit, as an example. So private markets or private funds give you a lot more optionality in the form of different or a larger set of operators, sponsors, strategies, locations. The secret is to select folks that you actually know, like, and trust. It's very difficult to do with the public REITs because to know, like, and trust the management team takes a lot of effort. How do you reach out to these folks? How do you have a conversation? When you operate in private space, you have that opportunity to get to know, like, and trust the manager, understand their strategy, ask them questions. So we're going to talk about further advantages of private real estate funds. As I mentioned previously, potentially better deals is one of those things that often available in private real estate deals, syndications, or funds. More options, better options in the form of yield, in the form of, because private funds, they lack one thing that public funds do have, and that lacking is actually a benefit. So publicly traded security, you could achieve liquidity fast, you could sell. So it's a benefit, but it's also a curse because you can't get a discount. There's a price discovery, there's a market price immediately. In public, that's the public markets. When you go to private markets, you can invest into a private one-off syndication or one-off fund, and the fund is a 5-year fund or a 5-year deal. And there's no liquidity. There's a lack of liquidity, in a matter of speaking. It's a curse if you need to exit, but it's a beauty if you need to convert traditional to Roth. You can get a discount, and a substantial discount, because you're not a manager, you don't have control of the entity, and you don't have liquidity. There's no liquidity mechanism. So you could get a substantial discount to the valuation versus the cash you invest in the deal. It's a significant tax benefit. You can inquire the set of CPAs that do these valuation studies, but it's a very powerful tool to convert traditional to Roth through a private real estate fund or a syndication. So there's optionality in the form of private funds, and there's optionality in the form of publicly traded REITs. So there's no right or wrong. Of course, consult with your attorney and CPA professional, but the idea is to mix it up. Access to private real estate transactions and funds give you a ton of additional benefits and options if you know how to use it.